Hello traders. In this video, I will be talking about how to use one of the most famous technical indicators used by traders around the world, how to use Bollinger Bands. You may have often seen this indicator in different strategies, but few people know how to use it separately from other tools and how to use it well and competently to find entry points. So the Bollinger indicator is a more advanced strategy of using moving averages. In order to add Bollinger Bands to the chart, we need to go to the indicator menu and enter its name there. Once we select it, it will appear on the chart like this. So, what does a common strategy for using moving averages sound like? Here, for example, we have a moving average with a period of 20. It is highlighted in orange. The classic strategy tells us that when the chart is above this line, we trade up. We see an uptrend and can now only trade trades up. And when the chart is below the moving average 20 in this case, it means the trend is down. We need to look for trades down. What is the problem with such a strategy? That it works well on trends like this? When the trend started sharply, we found the crossing point of the chart and got a good profit. But most trends don't look like this. They look like this. They are more gentle. They often have corrections, bounces, and so on. And if we use the classic strategy with moving averages, we will often get false signals on such trends. So Bollinger Band solves this problem in many ways. Because in addition to the moving average, this orange line here, we also have blue lines on the edges. This is the standard deviation. That is, Bollinger Bands show us not only the direction of the current trend, that is, if the channel is growing together with the sliding line, it means that we can see that there is an uptrend on the chart. When the channel is falling together with the sliding line inside, it is a downtrend. So we see the same thing that we would see if we only used a moving. But in the case of the Bollinger channel, we also see the volatility. We see the standard deviation now of the price. And the wider this channel is, the higher the volatility in the market right now. Many people often use Bollinger Bands simply as an overbought and oversold indicator. Here, for example, we can look at this graph. And often, especially novice traders like to do that. They open trades only when the chart touches the moving average channels. For example, here the chart has touched the upper boundary of the Bollinger, and beginners usually open a trade downwards. So they expect the chart to be overbought and should go down. Conversely, when the chart touches the lower boundary, they believe that the chart is oversold, that the asset is oversold, and open the trade up again. Then again, on the touchdown, a down trade is opened, and so on. Every touch opens a trade in the opposite direction, and this works really well on flat charts. But to use such a strategy everywhere is a mistake, simply because any slightest trend will give you a lot of negative signals. We can literally see this if we swipe the graph a little to the right. Here we got a medium-term trend, not that long a trend. But if we were trading on the Bollinger channel, just on bounces from the boundaries, then here we would have to open a trade down. That is, since we have a touch, we should open a trade down. Graphics went up, we took a loss. Here we see the touchdown again, we are again supposed to open a trade down. But as you can see, the upward trend still continues. And so this use of Bollinger Bands, as beginners use it, is very dangerous and will give a lot of negative signals. Every time the chart will not be in flat, but every time it will move to a trend. I want to share with you a better strategy for using Bollinger Bands without other third-party indicators. Just a regular Bollinger chart. We will find periods when our channels show low volatility and times when they move into higher volatility. Let's look at this on another graph. That's the situation we need. So, first of all, we are looking for areas of the chart where we have a clear flat, where there is no trend, where the price is barely fluctuating, the orange line goes straight. Of course, it will have a small deviation, as in this case, but it goes straight, plus or minus. So we're looking for moments where we have a very narrow channel. That is, we have low volatility in the market when we are flat and when the orange moving average is flat. And we need to wait for the moment when this channel starts to expand. You see here it started to expand both up and down. We see that the channel has started to expand. This is the moment when the channel was narrow and started to widen. It means that there is some activity on the market. It means that at this moment, trading volumes appeared, traders appeared on the market, and the chart is about to go either up or down. Okay, let's reassert. You need to find the narrow range first and find the transition to the wide phase. The phase when trading volume and volatility appear in the market. There is an additional tool for this, by the way. We can go to the Indicators tab and select Bollinger Bands width. That is, the width of the moving average. You see, on this chart, we need such areas where volatility is low and the channel is very narrow. When BBW shows a low value, it means that the volatility channel is narrow. And this is where it started to rise dramatically. That is, volatility has appeared on the market, volume has appeared on the market, and you can find the necessary moments as just visually that the channel expands. Or use an additional tool, and it shows the same thing, that the channel is starting to widen, the channel is getting wider. So now that we have moved into the phase where the channel is widening, we have to wait for the previous high of this narrow section to be updated. On this narrow stretch, we had a high right here at this mark. During the flat period, during the period of narrow Bollinger Bands, we had maxima here and extremums here. So the chart did not rise above this line, and here was the minimum, and the chart did not fall below this price. We wait first for the channel to widen, and then wait for one of these lines to be broken. If the high is updated, i.e. broken upwards, then we open a trade upwards. If the channel widened and the chart went down and broke this line, we would open a trade down. And as you can see, right here we have a good point to enter upwards and we get a good profitable signal. Let's look at the reverse situation. Here we already have Bollinger Bands on the chart. There's also BBW. You may use it, you may not use it, but to me it's also a prime example of how the channel is expanding. So we have a narrow channel, we have flat, the orange line is almost flat, the channel is narrow. This is where the channel began to expand dramatically with volume in the market. It expands both upward and downward. We look at the indicator and see the same thing. It shows that the channel was very narrow and abruptly began to widen. Just because the indicator is rising, it doesn't mean the chart will rise as well. This means that there is simply volatility in the market. It can go either up or down. What do we do next? We first set the minimum that was during this movement, during the narrow corridor, and the price did not fall below this point. And we also set the maximum right around here. Here's the properly exposed maximum, the maximum momentum that the price reached. And once the channel has started to widen, we wait to see which of these lines will be broken. If the upper line had been broken, we would have opened a trade up. But we see a breakdown of the lower line, the candle closes below the low, and we close the trade down at that point and make a nice profit on the trade down. Once again, I will repeat the conditions for entry. We need to first find a narrow period on the chart. Then we wait. When the channel starts to expand, either we see it on the chart or we use an additional tool, BBW, which shows that volatility has appeared, the channel is expanding, and then we wait for the chart to update any minimum or maximum, or it will go down and break the minimum of this period, or it will go up and break the maximum of this period. And in that direction, we accordingly open a deal. The strategy is very versatile. It actually works on trading session differences. Usually, there is such low volatility in the Asian and Pacific session when there is not a lot of trading and trading volumes are not very large and so on. And we have high volatility and serious trends during the European and American trading sessions when the main capital, the largest capital, participates in the market. When we have some range, which was set in the Asian or Pacific session, the main trading sessions open, and the chart goes either up or down. And at this moment, we have time to understand which way traders are inclined to trade. Therefore, This strategy can be used on different time frames, on different assets. It is important that you just try to use this indicator and supporting tools in your strategy. And if you are good at finding these moments, this strategy will bring you good profits. So try it, traders, share your results, and see you soon.